So that completes this exercise, which is we projected the balance sheet, which gave us a forecast of whether we're short or excess in cash. The answer is we're short in cash, which means based on our financing policy, we're going to create and draw on our line of credit and borrow the necessary $59. Would we update the income statements? Well, not really, because the preliminary income statements don't change because we made a simplifying assumption that we borrow all the money at the end of the year. But that's not really plausible. What would happen if we borrow earlier year? Well, then we have to then make iterations and then increase the changes. So this is our normal way we would run the line of credit, is we would borrow money and then during the year, and then we would then have to increase the amount of interest expense because it was outstanding for part of the year. Then that's going to make net income go down, which means we have to borrow more money. So this is the cycle where we're in a bit of a circular logic. So I'm not going to go through that in Excel, but I just want to show the concept that we made a very simplifying assumption, is that we need money, and we're going to assume that all the vendors will just sit tight and not get money until the last day of the year when we borrow money. But that's not realistic. If we were to try to make it more precise and borrow money during the year, we would then have to pay interest, and that kind of goes into the circular. But we can solve it with either a goal seek or just do iterations until the number goes down. Either way works. We're skipping that step because it's beyond the scope of what we're doing here. I just wanted to point out that we made a simplifying assumption. What are some of the alternatives to drawing on a line of credit? Well, we could cut dividends rather than pay out the 22 in dividends. We could save that money, and that would reduce the amount we have to raise. So 59 minus 22 means we could raise only 37, but you still have to raise some money. We could kind of break our policy and allow ourselves to borrow long-term debt. We could break our policy and issue more common stock. We could cut back growth, because you recall that by adding growth, it puts more pressure on adding assets. Or we could improve the operating plan by making our costs go down, by becoming more profitable. Remember those levers we could pull? Those same levers persist here. And the other thing to note is that it's iterative. We will likely try various alternatives and see which ones get us to a steady state where we accomplish our goals. So one way to illustrate it, and I won't have you do much of this, I'll just show how it would work, is let's say that rather than keep the assumption that we want to have the same assumptions as 2016, what if we allow ourselves to do something like have a cost reduction, where we could change our profitability by lowering operating expense? You may recall that our operating expense was 90%, but what if we drop that to 89.5%? Furthermore, what would happen if we could have our inventory to sales ratio be 16% rather than 20%? What we would do if we ripple through the math is we would see the free cash flow improve by $88. That would then, again, ripple through the whole calculation, and we would have lower operating capital. We would have better NOPAT, which would have a change in return on invested capital. So what would happen if we were able to accomplish all this? Well, at the very bottom, we see ROIC. ROIC at 8% was below WACC. That's not a sustainable position. But if we were able to make these changes in our profitability and our balance sheet, we would then change our ROIC to 9.2, which, as you recall, our weighted average cost of capital is 9. So this gets us above 9, which is good. So these would accomplish our goals. It doesn't happen with just a stroke of a spreadsheet. It happens with work. So we'd have to manage our business better, reducing our costs, reducing our inventory, therefore increasing our productivity, and then furthermore, manage our profits in such a way that we could deliver on the free cash flow, as mentioned here, and the growth in profits, which get us to 9.2%. What that also would do is increase our intrinsic value. The increase would then go from 45.75 to 81.37, which is a very good outcome, something the board would certainly like seeing. And this is accomplished the good old-fashioned way of earning more money, managing our business better, and then seeing the impact on both our profitability and our valuation. The balance sheet also would reflect that we don't have to borrow money. We would actually have enough money to pay an additional dividends, and that would increase our visibility and attractiveness as an investment. This is kind of what gives rise to the increasing price, is that we're demonstrating our profits are better and our balance sheet has improved and we're able to pay more dividends. New dividends would be this 36 in green, and our profitability would rise and allows us to pay our regular dividends, which is 10% growth, and that special dividend, which will allow us to still have increasing retained earnings of $24. So what we would do is we've identified and made changes so that we could generate a surplus. And the surplus now, in our example, we paid dividends, but we could have done other things. We could have bought back stock, we could have repaid some of our long-term debt, or we could have purchased some marketable securities as what we call a rainy day fund.